Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So what is a completion of a large quarter? First of all, before we talk about the completion of the large quarters, I'd like you to take a look at these price points that you will see on the chart here. I've written them for you. Remember on the daily chart there, I was showing you the move above $1.40 and then a move to as high as 1.4247. A lot of you will say, well, Ilian, this is not 1.4250. And I agree. It's definitely not 1.4250 because the high on that trading session was 1.4247. It's 3 pips below the actual large quarter point at 1.4250. Then on a move from 1.4250 area to 1.40 area, we have a low at 1.4019. That's not exactly the major large quarter point targeted exactly up to the pip at 1.4000. So why is that? Well, first of all, if you haven't noticed these type of price patterns, it's more than likely because the market normally tends to disguise the large quarter points. As a matter of fact, in most instances, you're not going to see a large quarter point being registered as a high, low, open, or close on any particular time frame that you're looking at. It usually will be a number that may look like a completely random number. It will be, let's say, 1.4247, or in this example, the high was 1.4267, and nowhere to be seen is the actual large quarter point exactly up to the pip at 1.4250. It's not that the market attempts to disguise these large quarter points on purpose so that no one sees them. It's just practically impossible for a multi-trillion dollars per day type of a volume and market that we have when it comes to foreign exchange market for prices to stop exactly at a large quarter point. So they either can stop short of it or they can surpass it by a few pips. They can come a few pips short of a targeted large quarter point and or surpass it. So this is why, with the quarter theory methodology, by recognizing the fact that in most instances prices are not going to stop at a targeted large quarter point exactly up to the pip, I've created a rule which helps us focus on what's really important. And rather than consider numbers like 1.4247 as a completely random number, or 1.4019, or 1.4231, or 1.4267 as being completely random numbers, we know what really is the targeted large quarter point there. And we focus on it. And that's the large quarter point at 1.4250. So I've created a rule which states that as long as prices, knowing that prices are not going to register as a high, low, open, or close on a particular time interval, the actual large quarter point exactly up to the pip, I designate the area within 25 pips, or one small quarter. Remember the small quarters? One small quarter of 25 pips from a targeted large quarter point as the area. That as soon as prices reach that area, then we consider the large quarter as successfully completed. So with the high at 1.4247, are we at least within 25 pips? Are we at least within one small quarter of 25 pips from the targeted large quarter point? The answer is absolutely yes. With the high here on this trading session at 1.4231, are we still within 25 pips from the targeted large quarter point? The answer, of course, is yes. With the low here at 1.4019, considering the large quarter point target in there on that bearish move for the euro versus the dollar was 1.40, prices stopped 19 pips short of reaching the exact large quarter point at 1.4000, but close enough within that 25 pips small quarter range for us to consider the large quarter as successfully completed. So this is why it is important to know that prices may not be capable of stopping exactly at a large quarter point, and a lot of times as a matter of fact, in most instances, to the untrained, unfamiliar eye to the methodologies of the quarters theory, these large quarter points will be completely disguised from what may look like completely random numbers. Again, look at it. 3 examples here, 4 examples just on this slide. 1.4247, 1.4231, 1.4267. They seem like completely chaotic random numbers. But aren't they all within 25 pips from the targeted large quarter point at 1.4250? So we focus on what's really important, and that is the fact that the large quarter in that example has been successfully completed by prices reaching at least the vicinity within 25 pips or 1 small quarter from a targeted large quarter point. And here's a couple of examples here as to what constitutes a successful completion of a large quarter and what constitutes an unsuccessful completion of a large quarter. Now, let's start with the successful completion of a large quarter. This area here, within 25 pips, that's a small quarter. Let's say the targeted large quarter point in this example would be 1.35. We have prices entering that small quarter of 25 pips between 1.3475 and 1.35, close enough for us to consider. Notice they do not reach the actual large quarter point at 1.35, but they do reach a number, enter that small quarter within the targeted large quarter point. That's close enough for us to consider the large quarter as successfully completed. Here's an example of an unsuccessful completion of a large quarter. The prices here begin to work on a quarter between $32.50 or 1.3250 and 1.35. So they move higher, but they never ever, you got multiple attempts to continue higher, they never actually enter that, what I also call, but I'm not going to go in further details. You can pick up the book and actually learn a lot more. In 1 hour time frame, I'm not going to be able to give you all of the that needs to be known about the quarter theory methodology. So I call this an undershoot area, 1 small quarter from the large quarter point. 25 pips above it is what I call the overshoot area. So prices come a little bit short in a previous example, but they enter that undershoot area, the small quarter from the targeted large quarter point. In this example, prices never do that. They stay outside of that area. They never complete the large quarter. And here is, now we said every significant price move starts from a large quarter point, targeting another large quarter point. So we know the beginning point of the price move, and we know the final destination as well. The direction and the destination is well known. And the range is also well known. It never, ever changes. So what does a trader do in cases when a large quarter is not successfully completed? Well, I explain in my quarters theory that because every significant price move starts at a large quarter point and also ends at a large quarter point, if a large quarter is not successfully completed, then in most instances, we can anticipate prices to exhaust and reverse back to a preceding large quarter point, which served as the starting point of the price move. So whether the large quarter point above or below is targeted, if we were to start at 1.3250, if this quarter was successfully completed, the end price point would be 1.35. But in this case, it was not successfully completed, this large quarter. Prices exhausted along the way, and then they reversed. And where did they reverse to? Again, a familiar price point, the preceding large quarter point at 1.3250. In a previous example, I showed you, let me move to that slide again. In the previous example, I showed you exactly that type of price moves. We move here, we complete the quarter, we reach as high as 1.4247. Prices don't break above the large quarter point, they stay below 1.4250, then they start working on a quarter back to 1.40 cents. They reach as low as 1.4019, complete the quarter to $1.40, never break below $1.40, they stay in that range of that quarter. So now the next move is back to 1.4250. On this day, they reach as high as 1.4231, close enough, within 25 pips from the targeted large quarter point. They never break above 1.4250. Then they reverse back, and they make an attempt to complete the quarter to 1.40. But now I want you to pay close attention to this price level. A low was established here on, what was it, April 3rd or 4th, at 1.4060. Unlike the previous time when prices have successfully registered a number at least within 25 pips from the targeted large quarter point, this time they stay 60 pips above $1.40 level. In the next several trading sessions, they never managed to progress any lower to complete the quarter. And as a result of that, they reverse back to, guess where? The preceding large quarter point, which in this case is 1.4250. This time around, however, they reach as 1.4267. Unlike the previous time, when prices remained below 1.4250, with a high at 1.4247, they are now capable of at least overshooting above the large quarter point at 1.4250. The first sign that there may be some strength this time around when prices could make a more decisive attempt to break above the large quarter point at 1.4250. This overshoots, because that, again, I explained that in my book, that overshoots are not what I classify as a decisive breakout. So this is one of the ways that we, with the quarters theory, that small quarters are utilized. If a price move does not exceed the range of a small quarter, if it's 25 pips or less above or below an important support or resistance level or an important large quarter point, we consider that type of a price move to not be classified as a successful decisive breakout. Why is that important? Because especially for new traders, they can consider a move that, let's say, 17 pips above resistance as a potential breakout. If you're not utilizing that type of methodology, a lot of traders come to find out that minutes later, prices reversed right against them. So traders, especially beginner traders, jump in thinking that this is the actual breakout, only to find out that that was just inertia, if you will. The prices have managed to push a little bit higher, but they're just overshooting an important price level by a few pips, and then they reverse back. And then, of course, if there's more attempts, the likelihood of a breakout after an overshoot, if there's more attempts, the likelihood of a breakout increases. But on the first attempt, what we see is just a little bit of inertia, prices overshooting the large quarter point. They overshoot by 17 pips in this example, above the large quarter point at 1.4250. They reverse a little bit, and then it is the second attempt that actually produces the decisive breakout right here, where we get to see prices really entering at that point the next large quarter between 1.4250 and 1.45 cents. So this is some of the premises as far as the successful transitions into the new large quarters and successful breakouts. And the ultimate result, here's the overshoot on a daily chart, the slide for you that I was showing you earlier. A little bit of an overshoot to $1.4267, a pullback in the opposite direction, of course. A lot of traders who thought that this is the breakout find that their stops are being triggered on that move after the fake breakout, if you will, the head fake. And then on the next attempt, the euro actually manages to produce the breakout transition its exchange rate into the new large quarter, above the large quarter point at 1.4250. Begin the work. Note here on the pullback, it's very important on these pullbacks for prices to maintain above a large quarter point, because you can see the breakout above a large quarter point. You can see it followed in a lot of instances by an actual pullback to the preceding large quarter point. They never break below that, overshoot a little bit, a few pips below it, stay above it, and then there's a further progression again to guess where. Well, it might be a guessing game for a lot of traders who are not familiar with the quarters theory, but for a trader who knows about the quarters theory, obviously after such developments, decisive breakout above a large quarter point, a pullback to the preceding large quarter point that's not followed by a break below it significantly, that's a sign of strength, so we can anticipate that the door is open there for the completion of the large quarter between 1.4250 and 1.45 cents. So what does that mean in terms of the actual, let's see here, can I actually go now to the presentation? Let's see.
Yep, you should be able to actually switch back. There should be an icon at the bottom of your screen there that should say return to your event window.
Okay, stop sharing and return to your event window.
There we go.
Okay, thank you so much. I haven't done a WebEx webinar for a while, so thanks for holding my hand through this.
Absolutely. It's very easy to get rusty after a while.
Yeah, it's been a while. Let's see here. So what does that mean for traders who actually can utilize the methodologies of the quarters theory? From what I showed you, so some of these familiar price moves, and how can we capitalize on them? Well, let's take a look, for example, on the option chains for the euro versus the US dollar, ticker symbol ICFX options EUU. I personally don't like options that expire in a short period of the time that I'm considering that as a potential trading opportunity. So I always look for options that expire a little bit ahead of time. And when I take a look at this particular option chain, I think that what would be of interest to me at least, because I'm not a very short-term trader either, I would be looking at something that expires maybe in December or at least September of 2011. I'll give you at least 5-6 months or so at least ahead of time. And then when we take a look at these strike prices, what can we see? Strike prices are in 50 pip increments or 50-cent increments here in this example. So if we think in terms of 50 pips or 50 cents, what does that mean? From strike price to strike price, if you add 50 pips, then an outlook from a trader might be a little bit of a narrow. With the quarters theory methodology, considering ranges and price moves, and as to remind you again, every significant price move I propose that occurs from one large quarter point targeting another large quarter point, that is a range, the type of a price move that has 250 pips. Okay, so that could expand the horizons, if you will. A lot of currency traders, especially spot currency traders, spot forex traders, are very short-term minded. They're more into what's going to happen in today's trading session. How do I get the next 10 pips? Well, with the quarters theory, we expand that horizon a little bit further into looking at what would be the next 250 pip move. And obviously, if one can catch with FX options, especially, or any options, when one can catch and with a greater probability of success accurately predict the next 250 pips of a move rather than the next 50 pips of a move, and that would mean a higher return as far as investment is concerned. Now, I wanted to show you something else as well, which I explain in my book, The Quarters Theory. Now, we know that there is a significant price moves from one large quarter point targeting another large quarter point, and if the large quarter is successfully completed, we have ourselves a 250 pips of a move, of a price move. But with the quarters theory, I also propose, because the large quarters are the 4 equal parts of each 1,000 pip range. So I propose that currency exchange fluctuations and prices in general do not fluctuate in a random manner, but rather from one large quarter point targeting another large quarter point in a systematic effort to complete the large quarters of each 1,000 pip range. Well, if prices were to complete all of the large quarters of a 1,000 pip range, then that means that the move could be a 1,000 pips of a move.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.